Hello, good day everyone. So for this video, we are going to discuss about partnership operations. Now to start, the accounting system of a partnership, including classification of accounts and accounting concepts, is essentially the same as that of other profit-oriented businesses. The accurate determination of periodic net income and its distribution to the partners is still the primary objective of the accounting process. To this end, a partnership is treated as a separate and distinct accounting entity. Net income is computed in the usual manner, that is, matching revenues and expenses, then credited to the individual capital accounts. However, the treatment becomes more complex because of the differences in capital contributions, inabilities, and talents of individual partners. So class, this is what are we gonna encounter, or this is the problem that we are going to encounter in the case of partnership operations. It's because since the partners have their different contributions, so there might be differences also as to the distribution of income. So aside from their contributions, they have also contributed different skills or services in the partnership. So that is why we have different methods in allocating profit. Now, at the end of the lesson, you will be able to determine proper distribution of partnership profits and losses among the partners, prepare financial statements for the partnership, compute changes in the profit and loss ratios, and correction of net income of prior years. Now let's start with the division of profits and losses. The partnership law provides that profits and losses of the partnership are to be divided in accordance with the partners' agreement. So actually class, there is no law that says that the partners must divide their partnership profits or losses equally. Neither that the law said that the partners' profits or losses must be divided according to their capital contribution ratio. Now, what prevails among all others is that the partners' agreement. So whatever is the agreement of the partners, so long as it is not against the law, it is the one that is to be followed in the case of distribution of profits and losses. Now, if no agreement is made between and among the partners, profits and losses are to be divided according to their original capital contribution. So there may be times where the partners was not able to state in their articles of partnership the manner or the method of allocation of profits. So that is why the law has specified that if ever there is no agreement among the partners, then it shall be divided according to their original capital contributions. So whatever is the capital contributions at the start of the partnership operations, so that is from the very first day that they agreed to be partners and they invested to the partnership. So whatever is their capital on that time, that will be the basis for the division of profits and losses. Now, should the partners agree to divide the profits only, losses, if any, are to be divided in the same manner as that of dividing profits. So if ever class that the agreement did not state any manner as to the allocation of loss, then whatever is the manner of allocating the profit, that would also be the allocation of loss. But in a case, of course, in a case when there is a different manner of allocating the profits and different manner of allocating the loss, then that shall be followed. So what the law says in this matter is just that if ever there is no agreement as to the loss, then whatever is the agreement of the profit, that should also be the manner of allocation of the loss. However, should the partners agree to divide losses only, profits, if any, shall be divided by the partners according to their original capital contributions. Okay? So, if ever, let's say for example, if the partners are too pessimistic to think that they will only get loss, or they will only be incurring losses, right? Now they only provided for the division of losses. But in that case, there's only an agreement as to the division of losses, but there is no statement as to how are they gonna divide the profit. Then the profits shall be divided according to their original capital contributions. Okay, so here is the summary. If the partners provided for a profit ratio, but there's no loss ratio, then what are we gonna follow in the losses is the profit ratio. But in a case where the one that is agreed or stated in the articles of partnership is only the loss ratio, but there is no profit ratio, then we must not use the loss ratio in dividing the profits. Okay, so if ever there is only a specification as to the loss ratio but no profit ratio, then we will have to follow the original capital contributions. Now next, the ratio in which partnership profits and losses are divided is known as the profit and loss ratio. The many possible methods of dividing net income or loss among partners may be summarized as follows. First, it could be equally. It could also be in an unequal or an arbitrary ratio. So equally class is, say for example, if there are two partners, then they are going to divide it equally. So the profit divided by 2 or multiplied by 50%. So if there are 3 partners, then the profit divided by 3. Now when we say unequal or arbitrary ratio, so it is not equal. So for example, if there are 2 partners and the profit and loss ratio is that 70% for the one partner and 30% for the other partner. It could also be if there are 3 partners, then let's say 50% for the one partner, 30% for the second partner, and 20% for the third partner. That is what we call arbitrary ratio. So again, it will depend upon their agreement. Now third, in the ratio of partners' capital account balances on a particular date, or in the ratio of average capital account balances during the year. So it could also be according to the capital, right? Now, it depends because we have this original capital contributions. We also have the beginning capital and the ending capital. So it depends upon the particular date. So when we say original capital contributions, that is the capital investment at the very start of the business operations. But when we say beginning capital ratio, then that is the ratio of the capital at the beginning of the year. So let's say for example, class, if the partners started their operation on the year January 1, 2019, okay, and it is now December 31, 2020, then when we say original capital ratio, then we will have to base their profit and loss ratio on their January 1, 2019 capital. But when we say beginning capital ratio, then we will have to base it on January 1, 2020. Okay? So the original capital is different from the beginning capital. Again, when we say original capital ratio, that is from the start of the operation. While when we say beginning capital ratio, that is only at the beginning of the year. Now we also have ending capital ratio, which is the end of the year. So at the end of the year, or end of the accounting period is December 31, 2020, then whatever is the ending capital on December 31, 2020, that will be the basis for allocation of profit. Now, we also have what we call the ratio of average capital account balances during the year. Now, class, if you're gonna base the profit on just a particular date, then it could be unfair, or the other partners may be unjustified because say for example, if A has a contribution of 1 million on the first day of operation, while B only has 800,000. But later on, A withdrawn his 300,000. So A only has 700,000 capital as of now. Now, if you're gonna base the profit allocation on the original capital contribution, as you can see, the original capital of A is 1 million. But since he withdrawn it later, which now becomes 700,000, so it would be unfair to B if we are to base it on the 1 million still, right? Now that is why, but of course again, that depends upon their agreement. But this is why there is also another basis, which is the average capital balances during the year. So we are just gonna get the average of their capital account balances during the year, and the average capital will now be the basis of our profit and loss allocation. Now we also have the allowing interest on partners' capital account balances and dividing the remaining net income or loss in a specified ratio. So, class, there may be times that the partnership agreement may state that there will be a 10% interest for the capital of the partnership during the year. So we just have to multiply 10% to the capital, and then that will serve as their allocation of profit. So whatever is the remaining amount, we are gonna divide it according to their specified ratio. Now, take note, class, that the interest here is not an interest expense, okay? Because it is not an interest that is used to pay debt, but rather, it is an interest on their capital. Now, take note, the interest on their capital is not an interest expense, but rather, a manner of allocating their profits. So that is why it is not to be considered as an expense, and so therefore, we must not present this interest in our income statement. Okay, so no presentation in the income statement. Now next, by allowing salaries to partners and dividing the remaining net income or loss in a specified ratio. So aside from interest, class, so actually interest is based on the capital contribution. Now, if we're only to provide for interest, so it would be unfair to those industrial partners because they don't have any money or property, or in other words, they don't have any capital contributions to the partnership. So that's why we also have this by allowing salaries to partners and dividing the remaining net income or loss in a specified ratio. So again, the salaries will just be stated in our partnership agreement. And lastly, this is the bonus to the managing partner based on the net income. So the managing partner will be given a bonus, okay, in case that the partnership is profitable. Alright, now let us start. Division of profit and loss in ratio of partners' capital account balances. So again, first we have the ratio of original capital contribution. So this ratio is used if no agreement is made between the partners. So of course, plus no matter if there is a given original capital, there is a given beginning capital, ending or average capital, no matter that there is given, but there's also a given profit and loss ratio, then as I've said, the profit and loss ratio will always prevail. Okay, we're just gonna use this capital account balances if there is no profit and loss ratio that is stated in the partnership agreement. So first, we have the original capital contributions and ratio of beginning capital balances. So lately, I've just discuss what is the difference between original capital and beginning capital. Okay, also the ending capital. I also discussed the meaning of ending capital. Now we have ratio of average capital balances. If the partnership agreement provides to divide net income in the ratio of average capital balances during the year, it should also state the amount of drawings each partner may make without affecting the capital account. Any additional withdrawals or investments are entered directly to the partner's capital accounts and therefore should be considered in the computation of the average capital ratio. So actually, the average capital ratio is a more justified basis in the profit and loss allocation that is based in the capital account balances, because we are gonna find the average of the capital, okay, and we're gonna consider the withdrawals, okay, unlike the original capital beginning and ending, in which we are only to base it on a particular date. Okay, now in an average capital, we can consider if how many months does this balance remained. Okay, how many months did the partner maintain this balance. Okay, so how many months did the partner has a 100,000 balance? How many months does the partner have an 80,000 balance? So we can just see how are we gonna do it later on in our problem solving. Now class, we have two, the simple average method and the peso month, peso day method. So simple average method, from the word itself, simple average, so that is just to simply add the beginning plus ending and then divide their sum by 2. Okay, and then we have peso month and peso day method, in which we're really gonna get the weighted average for the whole year, which is really a more justified. Okay, this is really more justified and more fair to the capitalist partners, but since it is more fair, it's more justifiable rather, then it is more complex. Okay, now let's proceed to letter E. Interest allowed on partner's capital with remaining profit or loss divided in an agreed ratio. So I've already discussed about this where we are to provide interest. Okay, and then say for example 10% interest of the capital. Okay, now take note class that since this is an interest, it is treated, the computation is just like how we make computation of an interest of a loan or a liability. Now, let's say for example that the start of operations of the partnership is on June 1, 2020, and then the reporting period is December 31, 2020. Then we also have to consider that the number of months. Say it is only 6 months, so the 10% must still be divided by 2, or 10% times 6 over 12. Or let's say for example, if we started operating on April 1 and then the reporting period is on December 31, so that is only 9 months. So the 10% must still be multiplied by 9 and then divided by 12. And then next we have salary allowances to partners. Partner salary allowances are not expenses. Okay, again, just like the interest, these are also not expenses in the determination of partnership income. They are just means of achieving a fair division of income among the partners based on time and talents devoted to partnership business. Partnership agreement should provide not only for partner salary allowances and the sharing of profits, but also for the treatment of salaries when losses are incurred. In the absence of an agreement, salaries are automatically allowed even losses are incurred. Okay, so class, just like the interest, salaries to partners are also not part of the expense. Okay, always remember that it is not part of the expense. It is just a means of achieving a fair division of income among the partners. Now, whenever there is the interest and the salary is just the same as to whether we are to provide it to the partners or not. So class, if ever there is a profit, so of course we are gonna give interest and salaries to the partners. But when there is loss, so you might think that, oh, there is loss, so we cannot anymore give salary and interest to the partners. No, we still have to compute for the interest and salaries of the partners. Okay, no matter whether it is a profit or loss, we have to compute salaries. Unless if there is an agreement that we should not provide for salaries to the partners whenever there is losses. Okay, that is the time when we are not going to provide salaries. But if there is no agreement as to that, then automatically, okay, we are to give salaries even when losses are incurred. Okay, now next, let's proceed to the bonus to managing partner based on net income. Now, the bonus to managing partner based on net income. A partnership contract may provide for a bonus to the managing partner equal to a specified percentage of income. When bonuses are to be allowed, the agreement must clearly specify the basis of the bonus. Okay, so bonus plus is given to the managing partner. Now, class, unlike the interest and salary, whenever there is loss, there shall also be no bonus. Okay? And no matter how you solve the bonus, when there is loss, you cannot solve any bonus. Why? It's because class bonus is based on profit. Okay? The interest is based on capital. So whether there is gain or loss, or whether there is profit or loss, we can always compute the interest. Salary is being specified. Say for example, 10,000 a month. 100,000 a year. Okay, that is specified. So, it is not based on whether there is profit or loss. Unlike the bonus class, bonus is based on the net income. We are going to provide a percentage of the net income for the bonus to the managing partner. So, if there is no net income, so we cannot provide any bonus. How are we going to compute for the bonus if there is no net income? And take note, you cannot base it on the net loss because that would give us a negative amount. Okay, there is no bonus when it is negative. Okay, it is not called bonus when it is a negative amount. Okay, now the computation of the bonus may be based on first, net income before allowances for salaries, interest, and bonus. Net income before allowances for salaries and interest, but after deduction of the bonus. So actually, this net income before allowances for salaries, interest, and bonus. So before all the deductions, just the net income itself multiplied by the percentage. Okay. We also have net income before allowances for salaries and interest, but after deduction of the bonus. Now look, the basis of the bonus is after the deduction of the bonus. How are we going to solve that? Okay, we can see later. Net income after allowing for salaries and interest but before bonus. So we are already going to deduct the salaries and interest but not the bonus. And then net income after allowances for salaries, interest, and bonus. So net income minus salaries minus interest minus bonus equals the basis for the bonus. Okay, so how are we gonna do that? So I hope you already know about this, since as far as my memory is concerned, okay, as far as I remembered, I have discussed this one in the intermediate accounting 2. Okay, so I expect you to already know about this, but just to refresh you, we are gonna discuss this one. Now, let's start with our first illustration. Okay, so this is a comprehensive illustration. So there could be many questions in this one problem. Okay, just like this one. Okay, this is just a short problem actually for discussion purposes. Right, this is just the basic process of how are we gonna divide the profit and loss. Alright, now, prepare a schedule distribution under the following independent agreements. So first, we have on the ratio of investments at the beginning of the fiscal period. Second, ratio of average capital. Third, interest of 24%. Fourth, allowance to bonus. Okay, we also have providing salaries. So these are independent situations and we are gonna solve this one based on one problem. Alright, now let's start with illustration 1. Okay, now the capital accounts of Castro and Diaz show the following facts for this fiscal year ended December 31, 2030. For Castro, we have January 1 balance, okay? And for Diaz also. Now they had their investments and withdrawals during the year, and then we come up with the ending balance on December 31. Okay, so I just have to check the Diaz. I guess there is a mistake for this. Just wait for a moment. Okay, so that is just right. There is no mistake as to the given. Now, the profit and loss accounts show a credit balance of 23,800 on December 31. So, what do we mean by this, class? The profit and loss account shows a credit balance of 23,800. So, this just means that there is a profit, right? Because if that is a debit balance, that means loss. But it is a credit balance, so that means profit. Now, let us try to solve using our first method of allocation. Alright, now first basis is in the ratio of investments at the beginning of the fiscal period. How are we gonna solve this? This is just based on the beginning balance. Alright, so we just have to compute for the total balance of the two. So for Castro and Diaz. So as you can see, the beginning balance of Castro is 26,000. The beginning balance of Diaz is 16,500. So how much is the total? That is 42,500. So what are we gonna do is just to make, since this is a ratio of the beginning balance, we are to make a fraction, okay, of these two. Now, since the total is 42,500, so the fraction is 26,000 over 42,500 multiplied by the profit of 23,800. Okay? And then for Diaz, we have 26,000, that is 16,500 divided by 42,500 times 23 times 23,800. So how much is that? Okay, I'm just gonna have to copy and paste. Oh, I cannot do this. Just have to solve it again. Okay, let us solve. We have 26,000 divided by 42,500 multiplied by 23,800. So that is 14,560. Okay, so therefore this is already the what do we call this? The share of Castro in the profit. And then we have 16,500 divided by 42,500 multiplied by 23,800. So we have 9,240. So if we're gonna compute 14,560 plus 9,240, then that is 23,800. And so therefore, for Castro, we have 14,560, and for Diaz, we have 9,240. Okay, so as simple as that. That is how we compute for the based on the beginning balance. Profit based on the beginning balance. Now, next, we have number 2. In the ratio of average capitals, investments, and withdrawals are to be considered as made at the beginning of the month if made before the middle of month, and are to be considered as made at the beginning of the following month if made after the middle of the month. So class, in the ratio of average capital, gonna consider their updated balances. Okay, so that's why we have to consider if how many months does this balance remain. Okay, so let us start with their balances. Okay, for the beginning balance, rather, let us start with the beginning balance. Okay, so we have Castro, beginning balance. So for the beginning balance of Castro class, that is 26,000. So since the 26,000 is not always 26,000 up to the end of the year, we have to get the fraction of how many months did the 26,000 remain. So again, this is 26,000. Okay, that is 26,000. And then multiplied by the fraction. So as you can see, class, that on March 30, there's already an additional investment, right? On March 30, there is an additional investment. So this means that this 26,000 or the balance is only 26,000 only up to March 30. So January 1 to March 30, how many months is that? That is January, February, and March. So that is 3. Okay, that is 3 months. Okay, so this is the months, that is 3 months. Number of months. Next, we have for March 30 from 26,000, there is an investment of 3,000. So you can see here. So this is already 29,000. Now, the next change of the balance is on May 10. Now, how many months is that? Take note, class, again, that investments and withdrawals are to be considered as made at the beginning if made before the middle of the month. So, the middle of the month is 15. So, the transactions that is made between May 1 and May 15 is to be treated as May 1. Okay, and the transactions from May 16 to May 31, that is to be treated as happening on May 31. So just like this one, since this is May 10, so we will have to consider it as that it happened on May 1. So from March 30, and then that is April. So that is only 1 month. Okay, March 30 to May 1, that is 1 month. Okay, so for you not to be confused, okay, I just have to type it May 10, okay, as is. So remember please be reminded about the treatment. This is treated as May 1. Now on May 10 class, there is another additional investment of 7,000. So 29,000 plus 7,000, that is 36,000. So how many months is that? Since the next transaction is on July 25, so this is treated as July 30. Okay? So from May, June, July, that is 3 months. Okay? And then from July 25, there is withdrawal. So 36,000 minus withdrawal of 4,000. So that is 32,000. Then the next transaction is already on December 31. So from July, since it started with July 31, so we will start with August, September, October, November, and December. So that is 5 months. Okay, so this is already until December 31. So there is already no transaction on December 31. So what we're gonna do is just to multiply 26 times 3 Okay, that is 78,000. Then we have 29 times 1, 36 times 3, and 32 times 5. Alright, now let us get the sum. We have sum of this 4, that is 375. But take note, class, that we will have to get the average. So we have to divide it by 2. Okay, number of months in a year, that is 12. So 375 divided by 12, so the average capital of Castro alone is 31 to 50. Okay, this is his average capital. Now, how about for Diaz? Now, let us compute for the average capital of Diaz. So, we have Diaz, number of months. Now, let's start with January 1. So, on January 1, we have 16,500. And then that is until May 18. So take note again that May 18 is treated as May 1. So that is from January, March, and April. Sorry, January, February, March, and April. Okay, so that is 4 months only. Or we can also count it from January 1. So the first month is February 1. Second month is March 1. Third month is April 1. And fourth month is May 1. So that is why that is 4 months. And next, on May 18, there is additional investment of 5,000. So 16,500 plus 5,000, that is 21,500. And that is until August 24. So take note that August 24 is treated as August 31. So from May, June, July, August, that is again 4 months. Now take note, class, to check whether you got the correct answer. You just have to compute the number of months. Okay, it should be 12. As you can see, this is 12. So my counting is already correct. Okay, for you to check whether your counting of the months is correct, it must total 12. Okay, now next, on August 24, from 21,500, there is withdrawal of 2,000. So that is now 19,500. Now take note, after August 24, there's already no other transactions. Okay, this balance 19,500 is already on December 31. So meaning from August 24, or treated as August 31, we will start counting with September, October, November, and December, and that is 4 months. Now as you can see, class, the total is 4 plus 4 plus 4, that is 12. Alright, now we have 16,500 multiplied by 4, 21,500 by 4, 19,500 by 4, so we got its total, and then we just have to compute for the sum. So that is 230,000 divided by the number of months in a year. So that is 12 still. So 230 divided by 12, we have 19,166.67, and this is the average capital of Diaz. Okay, and this one is the average capital of Castro. Alright, so this is their average capital balances. But class, actually, there is another computation for the average capital balances. So maybe this type of or this method of computation could be difficult to sum. So there is another method of computing for the average capital balances. So more or less it is just the same, but the counting of the number of months is different as to this method. But again, it will just give you the same answer. Okay, now for this method, we will have to consider January 1, March 30. Okay, I'm just gonna have to copy May 10 and July 25. So this is for Castro. And then, since this is the other method, so no need to get the accumulated balance. Okay, as you can see, there is a balance of 26. On March 30, okay, instead of adding 26 plus 3,000, we only have to put 3,000. Okay, so no accumulated balances already. No computation of accumulated balances. So on May 10, there is additional investment, 7,000. And on July 25, there is a withdrawal of 4,000. So take note to make it negative. Okay, negative. Why? For it to be considered as withdrawal. Okay, because we are the Castro withdrawn. So it should be negative. Okay, but for the number of months class, we will have to compute the number of months to December 31. Okay, so say for example, January 1 to December 31, that is 12 months. March 30 to December 31, that is 9 months. May 10 to December 31, how much is that? May, June, July, August, September, October, November, December, that is 8 months. July to December, that is, I guess, 5 months. That is count. July, sorry, we have to consider it as July 30, so July 31 rather. So we will have to start with August, September, October, November, December, that is 5 months. Okay, is that correct? August, September, October, November, December, that is 5 months. Then, same method, we will have to multiply each. Multiply and then compute for this sum. Alright, so the total here is 375,000 and then divide by 12, just like what we did before. So divided by 12. So 375 divided by 12, that is still 31 to 50. So it is just the same. So class, the advantage of this method is that you don't need to get the accumulated balance. Okay, especially if it is hard for you to do mental math, okay, for the addition and subtraction. So you don't need to do that, okay? You don't need to compute for the accumulated balance. But what is hard in this method is that you have to compute from the specific date until December 31. Okay, so maybe it could be hard from the others, but it could also be easier for the others. But what is the disadvantage of this one is that you cannot check. Okay, you cannot check. You cannot add this one to make it 12 because it will never become 12. Okay, unlike for this one, you can check whether your counting is correct. Okay, you can confirm whether your counting is correct because the total must be 12. Unlike here, okay, you cannot total this one because we are counting from the date up to December 31. So it can never be 12. Okay, so this is the advantage. You don't need to get the accumulated balance. Unlike here, you still have to compute for the accumulated balance, but as to the number of months, you can confirm it. Okay, you can confirm it. You just have to add, and then if it is 12, then that means that your computation or counting of months is correct. Okay, so that is for the two methods. Okay, for the Diaz, I will not compute it already because it is just the same with what I did for Castro. Okay, now let's proceed to okay, this is just the average capital, so we will have to compute for the profit allocation. So we have Diaz and Castro. So just like what we did with the beginning, we just have to add the two. So we have 31 to 50 plus 19,1667. So that is 50,416.67. So what are we gonna do is to multiply the profit of 3,800 multiplied by Castro 31 to 50 divided by the total of how much was that? That is 50,416. 50,416.67. And for Castro, we have 23,800 multiplied by 19,166.67 over 50,416.67. Okay, so that is how we do this. And then for the profit share, okay, let us compute 23,800 multiplied by 31 to 50 divided by 50,416. This is for Diaz, and for Castro, we have 23,800 multiplied by 67 divided by 50,417, that is 9047. So we're gonna add 14,752 plus 9047, that is 23,800. This is their profit share. Now let us check, class, whether there is a difference from the first method. Okay, I'm going to show you this. Okay, let us compare, class. Just gonna hide it. Okay, so as you can see, in the first method, this is based on beginning capital, we have 14,500 and 9,200. In the second method, based on average, we have 14,700 and 9,000. So it is just immaterial. Okay, so whatever is the agreement of the partners, that will serve as your basis of allocation. Alright? Okay. So okay. Um oh. Alright, so I apologize because uh there is a correction as to the given. Let me check. I just have to check. Alright, so this is where we okay, so we had alright, so I guess I apologize if you have come up to this part of the video. I apologize if you have listened to the previous part. Okay, but there is a mistake as to here, class, because the May 18 should be treated as June 1, May 31, right? So there's a mistake as to this one. It should be from January, March, April, May. January, February, March, April, May. So this should be 5 months. Okay? And for the May 18, it's treated as May 31. So we only have June, July, and August. Then we have 3. And then August to December, that is 12. Okay, so here is our average capital. So same method. So my mistake was only that the number of months was not the same. Okay, so we have 2 to 5. I mean, the number of months was incorrectly counted. Okay, then we have 2 to 5 divided by 12, we have 18, 750. So for our formula, class, this should be 23,800 times 18,750 over 50,000. Okay, 50,000. And then for this one here, 31,750 over 50,000. So here is the correct answer. We have 14,875 for Diaz and 8,925 for Castro. Okay, that is for the average capital. Now, alright, so class, since it would take too long for me to edit this video, so I apologize for the mistakes I have made regarding the number of months. So as to the other procedures, it is correct. It's just that the counting of months, I have mistakenly counted it. Okay, so it would already take too long for me to edit this video, so just please bear with me whenever there are mistakes. Okay, so I will not edit this video, so please bear with me. Okay, now let's proceed to number 3. So for number 3, interest of 24% on average capital, salaries to Castro and Diaz 36 and 24 respectively, and any balance equally, investments and withdrawals are to be considered as in number 2. Alright, now let us compute. And then for this time, there is already interest, there's already salaries, and the balance must be divided equally. Now, how are we gonna compute that? So this table, class, is very important because the table that I am going to make is important because this is the one that we are to usually follow in answering partnership operation. Okay, but it is just a simple table where you are gonna put here the names of the partners and then the total. Okay, and this one here is for the interest, because usually the interest is the one that is first stated. Then we have the salaries, because usually the salary is the one that is secondly stated. Okay, and then there is no bonus, so let's proceed to remainder. So what is remainder? I hope you know the definition of remainder. Okay, so what remains? Net income minus salaries and interest. So what is the excess? Okay, that is the remainder. So for the interest class, we have 24% on the average capital. So we have already computed the average capital. So that is for Castro, 31 to 50. And then we just have to multiply it by the interest of 24%. 31 to 50 multiplied by the interest of 24%, so that is 7,500. Now for Diaz, the average capital is 18,750, as you can see in the above example. 18,750 times 24%, that is 45. So to get the total, 75 plus 45, that is, this is 75 plus 45, that is 12,000. Okay, now next, for the salaries, that is 36,000 for Castro and Diaz respectively. So 36,000 for Castro and 36,000 for Diaz, 24,000. So remember, class, that if there is a given salary, let's say for example that the given salary is 36,000 annually, but they started their operations on February 1. So take note that from February 1 to December 31, that is not 1 year, that is only 11 months. So in that case, you have to get the ratio of the 11 months. So for example, 36,000 times 11 over 12. That would be our salary. Okay, but since in this case, we started on January 1, so no need to get the ratio. 36 and 24 is already good for 1 year. Okay, now 36 plus 24, that is 60,000, and the remainder will be divided equally. So how much is the remainder? So we first have to get the total. So the total is 23,800. So whatever is the excess, that will serve as our remainder. So we have Oh, look class, as you can see, oh, this is much bigger. Okay, 12,000 and 6,000. Then the one that is stated here, okay, bigger than our profit. So what are we gonna do in our remainder? We are to deduct. Okay, the remainder is a deduction. Okay, so how much is to be deducted? So you just have to get the difference. Okay, 12,000 plus 60,000 minus 23,800. So we will have to deduct 48,200. Okay, so again, I'm going to repeat. Okay, we will start with 23,800. Okay, to get the negative one. 23,800 minus 12 minus 60. Okay, so I got the negative answer, 48,200. So for the remainder, just multiply the 48,200 with the given ratio. Since the ratio is equally, so we just have to divide it by 2 or multiply it by 50%. This one times 50% multiplied by this one times 50%. Okay, so they are equal as to the remainder. Now for the profit share of Castro, let's get the sum. Okay, that is 19,400, and for the profit share of Diaz, that is 4,400. Okay, as you can see, it is different from number 2 because of course we had another method of allocation. Alright. Now, so let's proceed to the fourth one. Allowance to Castro of a bonus of 25% of the net profit after bonus, interest of 10% to be allowed on the excess of the average investment of one partner over that of the other, and any balance in the ratio of 3:2 to Castro and Diaz respectively. Okay, so here there is a bonus, and then there is an interest, okay, and balance. So for number 4, okay, for number 4, so same format, we have Castro, Diaz, and total. So the one that is first stated is bonus. So how are we gonna get the bonus? So accordingly, Castro is to be allowed a bonus of 25% net profit after bonus. So how are we going to get the profit after bonus? So class, profit after bonus is bonus computed after the deduction of the bonus. So say for example, profit less bonus equals profit after bonus multiplied by the percentage, okay, and then that is the bonus. So as you can see class, our profit here is 23,800, right? Now to get the bonus, we need the bonus. So how are we gonna do this class? Okay, to get the bonus, we need the bonus. So there is no bonus yet. How are we gonna get the profit after bonus? That is profit less bonus. Okay, and then multiplied by the percentage of, accordingly, that is 25%. So how are we gonna get the bonus? Profit after bonus times bonus. So we cannot get the answer. How are we gonna do that? So here. Now, since our basis here, class, is the profit after bonus, so take note that whatever is the basis, that is always the 100%, right? Now, take note that our bonus is 25%. So if our bonus is 25%, and to get the profit after bonus, we deducted the bonus. So this just means that our profit here is the 125%. So that is why, class, when you are to solve for a profit after bonus, okay, you are gonna divide. So 23,800 divided by 1.25 in order for you to get the profit after bonus. So how are we gonna get this? 23,800 divided by 125%, so that is 19,040. Okay, in short, class, this is our formula in short. Okay, the one that is below. Okay, the one that I type here is just the breakdown on why do we call it profit after bonus. Is because we deducted bonus after profit, and that will serve as the basis for the bonus. So our bonus is 19,040. So if you're gonna deduct 23,800 minus 19,040, that is 4,760. Now 4,760 times 25%, that is, oh, sorry. Let us compute it again. 23,800 divided by 1.25%. Sorry, divided by 1.25%, and then we will have to multiply 25%. Okay? So again, 23,800. So I'm gonna put it here. We have the formula 23,800 divided by 125% times 25%. Okay, that is 4,760. 4,760. Now, if we're going, so we answered it through this one. 23,800 divided by 125 times 25. Now, how about if we're gonna follow 4,760? So, 23,800 minus 4,760, that is 19,040. 19,040 times 25%, that is 4,760. So our profit after bonus is 4,760. Okay, now next, this is our bonus, 4,760. So we're gonna allow it to Castro, 4,760. So no other bonuses. The total is 4,760. Then let's proceed to the interest. So class, accordingly, the interest in number 4, the interest of 10% is to be allowed on the excess of the average investment of one partner over that of the other. Okay, so we are gonna get the average capital of the both. Okay, and whichever partner has the excess, he's the one that is to be given interest. So class, take note that this is not always the case. Okay, because again, we are to base on what they agreed. So since they agreed that for the interest, accordingly, for the interest, okay, so I'm going to label this one. This is for the bonus, and this is for the interest. So accordingly, for the interest, we are to compute for their average balances based on simple average. So the average balance of Castro, okay, that is 26,000 plus ending 32, right? And then divided by 2. Okay, that is the average balance of Castro. So 26 plus 32 and then divided by 2. Okay, 26 plus 32 divided by 2, that is 29,000. While for Diaz, we have 16,500 plus 19,500. Take note, we are gonna get the average, so this should be beginning plus ending divided by 2. Okay, so we have, I'm just gonna copy this one, then make it a formula. Okay, So we have, oh, what happened? Again, 16,500 plus 19,500 divided by 2. This is 18,000. Alright. So the average capital of Castro based on simple average is 29. For Diaz, that is 18,000. So accordingly, the excess of the average investment of one partner over that of the other will be given interest. So we are to get the excess of the capital of Castro over the capital of Diaz because Castro is higher. So the excess of Castro is 29 minus 18, that is 11,000. So we are to give interest to Castro, and accordingly that should be 10% interest. So 11,000 times 10%, that is 1,100. So this is the interest to Castro. So only Castro will be given interest. So that is 1,100 to Castro. So we have the total of 1,100. So no bonus and interest for Diaz. And then after that, let's proceed to the remainder. So for the remainder class, we have 3:2. Okay, so we have to compute first the remainder. So to get the remainder, the profit is 23,800. Okay, so how much is the remainder? 23,800 minus 4,760 minus 11, that is 17,940. So for the remainder, that should be 3 over 5 for Castro and 2 over 5 for Diaz. So to compute, 17,940 times 3 over 5, that is 10,764. Okay? And for Diaz, we have 17,940 times 2 over 5, that is 7,167. So to compute, we have the sum of 4,760 to 10,764, and then we have 7,167. So this is the profit allocation of Castro and Diaz. Okay, so that would be all for the first part of the video. For number 5, I will just discuss this one in the second part of the video. So please proceed to the second part of the video after you listen to this video. See you on the part 2.